Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today I wanted to talk about one chart that can have two very important implications for those that are seeking income using options, and specifically for covered call traders. It's going to be, I think, an interesting take on what might be a familiar chart to some of you. I'll talk about that more in just a moment. We're going to be reviewing our example paper money portfolio and kind of ripping the Band-Aid off there, but a lot to cover before we can get to any of that. Let me say hello to everybody that's joining us out there in chat already. Hello there, Rice Bird and Selva, Will, George, Jerry, Eva, Andrew, Lawrence, everybody else. Thanks for joining us week after week. We really do always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Monday webcast series, and we kick things off promptly at 2 Eastern. We go for about 45 minutes. If you want to budget that in your calendar, that'd be fabulous. I also want to let my live audience know that Barb Armstrong is hanging out in the chats with us. Barb's going to be addressing any questions that I can't get to. Thanks for having my back there, Barb, and everybody knows and loves Barb. They know the experience and the knowledge that she brings to this. So yeah, thanks for helping out, Barb. Barb and I would also like to issue an invitation to everybody listening. If you have an account with X, give us a follow. You should be following all your favorite presenters there. You can follow Barb on X at Barb Armstrong CS. My handle there is at Cameron May CS. But let's get into this discussion. I want to take a look at this chart. Maybe seeing a familiar chart for some of you, maybe looking at a new, looking at the markets through a new lens for others. But of course, before we do that, we need to consider the risks associated with what we are explaining today. Trading and investing certainly carries risks, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's go. Let's set an agenda, first of all, for what we're going to be covering. First thing that we need to do is, yes, look at the existing positions in our paper money portfolio. They're all bullish. This webcast is all about bullish strategies known as covered calls and short puts. So when the markets do what the markets have done, yeah, those strategies can take lumps just like any other bullish strategies. Interestingly enough, sometimes they can soften the blow a little bit when compared to just an outright stock position. But still, there's some damage that's been done to the paper money. We're going to go have a look at that. Then we're going to look at what's going on with the markets, and I want to frame within that this review of this chart. So here it is. We're going to look at what's going on with the S&P 500. Then we're going to look at something known as the volatility index, the VIX. Yeah, some of you are perfectly familiar with the VIX, but it can have two important implications for covered call traders, interestingly, because they own stocks and sell options. And that one chart can have implications for both sides of that strategy. So I want to talk through that. And then we're going to plan in place a covered call trade before we're done today. So let's go have a look at that paper money portfolio. We are sitting in the red across the current positions right now, not surprising at all. We have 3 covered calls. We have 3 short puts. That means 6 bullish trades. And the markets have come down. So these have come down right along with the markets more broadly. But let's look at what's going on with our Apple position to kick things off. With Apple, we sold things originally right here, this blue oval. That was where we first started what we might call the income wheel, or the wheel strategy with short puts and covered calls. But we sold a 21st of March 235 put for $3. We ultimately were assigned at 235. Giving us sort of a break even at that point of 232, taking the purchase price of the stock, 235 minus the $3 credit, already a realized gain. And then we sold a call against that new stock position, lowering the net break even point of our trade to 231.12. Well, that was nice last week. We were just a little bit below that break even point. Boom. Big collapse since last week. You can see that we've fallen down below previous lows at this point. A technical trader may be questioning whether they want to remain with a position or not, of course. That's always up to the individual investor, but this is where we find ourselves. I don't make any changes to existing positions in between these live stream webcasts. So when we meet, then we talk about, well, here we find ourselves, whether positive or negative, where do we go from here? So this 235 call without even looking, what do you think has happened with the value of that? We sold it for 88 cents. I'm guessing we can buy that back for pennies on the dollar, maybe roll to a different position if we decide to stick with our stock position. Let me get your input, because nobody has a perfect insight into what the markets hold ahead for us. But do you think it's time for maybe traders to start taking off their stock positions or hold steady, recognizing that major indices like the S&P 500 have already pulled back about 20% or maybe even more? What do we think? So that's where our Apple has dropped. Yeah, Laura, it's probably almost worthless, this call right here, right? Right now, let's just make a decision. Are we, as the hypothetical owner of these positions, do we want to hold on to this Apple stock? Do we think maybe it finds some support down here at these 12-month or near those 12-month lows? Let's look at that on a longer-term chart. And look at that. That's interesting. When we get that longer-term perspective, we really do seem to be sitting right down a price floor, previous price ceiling. I think we're going to retain ownership of this position, the stock position. Let's close out that call. 235, let's see what it's trading for right now. Go to our monitor tab, open up our Apple position, sold that for 88 cents. It's worth about 8 cents. So we could close that out for about 90% of its original maximum gain that the call might have delivered to us. And if we were to go out and look at selling another call, this is going to be interesting. I haven't looked this morning at Apple's options chain, but what might a trader expect when they go look at premiums across a lot of stocks right now? And this is teasing into our discussion of the VIX that I want to review. Options premiums are sky high relative to where they've been over most of history. Yeah. So when we're looking to sell for income, maybe there's a little window of opportunity. Yes, it comes with risk, but premiums are really high right now. Let's go see if that's the case with Apple. And with Apple, we also want to keep in mind there is an earnings announcement coming up. That one's out on the 1st of May. Maybe we sell one before that. Let's go look at our trade tab. Maybe we'll push this out closer to the 1st of May, the 25th of April. Stocks at 181. We bought the shares for 235. So be aware, if we sell a strike below 235, we're basically agreeing to sell the shares for less than we paid for them. That's one of the things to remember when we're entering into a call contract. Yeah, and we'd have to go so far out of the money to not be entering into a contract where we're agreeing to sell shares below the current below the price that we paid for them. Some traders might not choose to do this. Now, if we sell far enough out of the money, maybe we're not going to get called. That's a possibility. But, oh, thank you, Eva. Yep, there is a survey. I'll talk about that in just a second. You know, recognizing this, I don't usually do this, but how about we just do this? I'm going to close out the existing call position. I suspect that's going to be the case on our other two calls, but I'm not going to be selling calls against those, selling it for new income just yet. All right, let's right click here. Let's create a closing order and buy back that call. We'll try to do that for 8 cents. Now, when an option has gone so far out of the money, it can actually start to have some liquidity issues. There can be some a widening of the spread between the bid and the ask price. So it might take some finagling to try to get an order filled. I'm going to just see if we can get out for 8 cents here, though. Buy that 235 call back for 8 cents limit. Certainly not guaranteed to fill on that limit order. Let's click confirm and send. See if we can buy this back. The max profit, max loss here would be if we were initiating a new opening transaction. This is a close. We don't worry about that. But there is a potential commission here to add to, it might cost us $8 to get out, plus 65 cents, so $8.65. Let's send that off. And look at that, bought it back immediately for 8 cents. Just to prepare you, sometimes paper money is a little bit more forgiving than real life, but it could have filled. I'm not saying that it couldn't have. I would expect maybe a little bit more of a pause there, unless we were coming well above the market. Anyway, so we're done with that call. We're going to retain the stock position. We'll look at that again in future webcasts. IBM, similar scenario here. Sold a 255 call for $3. We can get out for close to 90% of that for about 34 cents. Let's go see what's going on with our IBM chart. In this one, we've previously sold a call. We've already realized a gain on this 21st of March call that just expired. And then we sold another April call for $3. Maybe we can realize the gain there. So that it's the income from those premiums that can actually, lessen the blow a little bit here. We're still losing money net on these trades. But if we were to compare this to, let's say, a trader who just bought the stock and hasn't been selling calls against those positions, they would be further underwater. So sometimes a trader might be satisfied with just losing less than they might have otherwise. It's never fun to lose money, though. I can definitely empathize with that sentiment. But in any case, how about we look to buy back those calls? And look at this, the stock is already rallying. If we don't have a lid on it, so to speak, with a short call, and it rallies further, well, there's no cap to how high it could go. And could we get back to this break even in this volatile market relatively quickly? It could. We'll see where we go from here. But I'm going to buy back this call. Right click here. Let's create a closing order. Buy that one. Looks like it's creeping up already. It was 34 cents. It just popped up to 46 cents. But you can already see the wide spread. Let's see if we can get out for a little bit less than just paying the natural. Let's shoot for 40 cents. Okay, if we sold this for $3 and we're able to buy out for 40 cents, that would be a 260 realized gain. Setting the commissions aside here, it'll be a little bit less than that after commissions. But let's click confirm and send. Buy those calls back. 65-cent commission. Let's send the order off and see. Yep, closed at 32 cents. Okay, we were thinking 34, got filled at 32. All right, one other call position here, and that is the Wells Fargo position. With this, we sold the 72.5 call for $1.45. It's worth 28 cents. So this is more like an 80% of its maximum gain. About 14.5 cents would be 10%. 29 cents would be 20%. Yeah, so we're buying out with maybe 80% of the best these calls could have done for us. Let's look at this on our chart. Here's our Wells position. We already closed out one call at $1.65 profit. See if we can close out this one for maybe, if we pay 28 cents, let's call it 30 cents, maybe $1.15 of additional profit. That can lower the damage. However, it doesn't make us feel dramatically better about the fact that we bought at $70 and it was recently worth 80 and now it's only worth 62. So net, it's kind of like we're getting a $65 value out of a $70 investment. Our break even is up there around 67. Eva, you saying take it? Let's get out of this. Yeah, I'm going to do that. Okay, let's close this one as well. Right click on this call. Let's create a closing order. Buy that back. You know what? I'll say we're willing to spend up to 30 cents. It might not cost that much right now. We'll see. We're just going to put in a limit. Even when we feel like we're being generous with our limits, it's not a guarantee that this is going to fill. But let's click confirm and send. Buying back that 17th of April, $25 call, 72.5, 25th. Boy, keep going too fast and just read it wrong. 17th of April, 2025, 72.5 call for 30-cent limit. There is a commission here as well. Let's send that off. And we're out for 27 cents. Okay, so sold it for what is it? $1.40. What was it? $1.40 something. Anyway, good enough. It was $1.45, was it not? Anyway, Done with that. Wanda says, what was the original trade date on those covered calls? So Wanda, I have those on my chart here. You can see this one. When you see one of my lines sticking out here, that implies wherever the line started, that's where we started that trade. So we sold a call here. That one expired right there. So we sold another one here, and we just closed that out right there. So now, now that we've closed that out for $1.27, I believe, that was a pretty good profit, but we're still below break even on that trade net. And then finally, we have some short puts. We have Meta, we have NEE, and we have Visa. With Meta, these positions, well, like in this case, let's see, Meta, I think we sold the 510 put, that's right. Stock's actually trading at 518, 519. That's a little bit above our expiration break even. There we go. Sold that 510. We definitely dipped down below break even. Our break even is at 504.30, but you'll notice we're actually losing money as of this moment. That's because break even is calculated as of expiration, that assumption. We're not to expiration yet, but we're back to where we need to be up there in our max gain territory. We're above our strike at 510. So we're going to leave that Meta position alone. With NEE, sold the 72.5 put. Stock's trading closer to 66. So you can see this one, we have an obligation where somebody has the right to sell us shares for 72.5. They're only worth 66. We could maybe choose to buy out of this, but it would cost us a lot more than we collected on that premium. That's sort of a trade-off. If we want to stop the bleeding, it's not that we are eliminating the wound. It just, the wound isn't getting any bigger. So the question becomes for our trader here, do they think that the thing is going to continue to fall? You can see how we've had a strong sell-off, just like much of the rest of the market. Here's where the price is on NEE. Could we recover back up to our break even? Could we recover all the way back up to 72.5? It's possible. It's not likely. But even if we don't get all the way there, it could reduce the loss that we have. Getting out right now prevents additional loss should the stock continue to fall, but getting out right now also eliminates any possibility of smaller losses should the stock continue to recover. So you'll notice each of these decisions really comes down to what is the trader's current view of what the markets are doing more broadly, because a lot of these stocks are going to move pretty close in step with what the markets are doing. So with something like this, if the trader really has conviction that the markets are likely to recover, at least to some extent, well, maybe we hold. And that's what we're going to do. Whether we'll learn lessons from this in future webcasts in either direction. Another thing that we could do is maybe scale out of the position, buy back one of the puts since we sold two. But I'm going to leave them both on, and I'll be doing the same thing with Visa. We sold the 330 put. That one has fallen well below its break even. But I mean, this is a good example of how rapid in a volatile market recovery can happen. Imagine if our trader had decided this morning, wow, this is just terrible, I'm going to pull the plug. Well, that probably cost them a lot more to buy out of a short put than it would cost even just right now, a few hours later. So I'm going to leave this one on, but we're well below our break even. None of this terribly surprising when you have bullish positions and the markets have done what the markets have done. But so we've made a few adjustments to our portfolio. We're going to leave the other three intact. Let's go see what's going on with those markets. Let's go see what's going on with the S&P 500. I think a lot of you saw, it seems that there was some false news that came out about a potential 90-day hiatus on the tariffs. Markets got excited about that, but that was after, just continued concern about the tariffs. And then it turns out that there's not going to be a hiatus, and the markets pull back, but then sort of recover again. Ooh, that turns into quite a day on the S&P 500. Look at that range. 411 points on a 5,000 point index. That's an 8% range from high to low. So if your heart's beating a little bit faster, if you're paying attention closely to what's going on in the markets, it's understandable. Where the market's headed from here. You know, I scheduled a tweet to go out right when this webcast, a tweet, look at me, a post on X. But a post on X to go out about just some general observations about the S&P 500. And somebody on a previous post earlier this morning had noted, hey, Cameron, did you see on the longer term? Let's go have a look at this. Let me switch this up. I'm going to go out to like a 10-year weekly view. Look at where the low for today lines up with the cyclical high of 2021 into 2022, right through there. Do you think that they would be alone in observing that a previous really substantial price ceiling may be on this broadly followed index, a possible new price floor after this pullback here? That's certainly a potential. Time will tell, right? But also, as we go back to this one-year chart, what is significant about how far down we extended today? This is another post that I made on X just this morning. Well, when we got the initial sell-off, as tough as that felt at the time, oh, this is terrible. Got down 10.5%. We call that correction territory. Then we rallied, and we sold off again more than an additional 10%. We actually got down to bear market territory on the S&P 500. Been a while since we've been down this far. But yeah, this is, for some technicians, they draw that line in the sand at 20% sell-off from a peak is their a technical definition of a bear market. So does that mean that the bears are going to continue to rule the day? We'll see. But there may be this little bit of technical hope. We've come down to that support. Let's see if it holds. Mark says so much for your earlier claim that the S&P has a strong resistance of 5250. So you're looking at maybe up here. Yeah, I don't think that you would be alone in that observation either, Mark. Yeah, but it didn't hold, right? Eva is comparing this to COVID. Yeah, actually, you look at the proportions on that long term. Now, the distance traveled, should we measure that? Let's go back here. Back to our 10-year weekly. There's COVID right there. Here's the present day. How far down did we pull? You can actually use the trend line tool in your drawing tools as a measuring device. Go to the start of a move, click once, move to the bottom, and as you go down, you'll notice it's giving you a bunch of the characteristics of the physical characteristics of that line. Over 38 days, this is a weekly chart. That's why we're only seeing 6 bars, but there are 38 days represented because we're just looking at weekly bars. Down 36%. We're not down 36%. It's not bad, not as bad so far as COVID. But could we get a recovery, whether we ultimately go down further? Could we get another V-shaped recovery? I think a lot of traders might be asking themselves that same question right now. But in any case, let's just say that we're sort of in the camp, hey, we've pulled back to this previous high. And one other thing I saw someone else note today is that if we measure the distance traveled from low to high, what does that coincide with? From this low back in October of 2022, right up to that peak, we've given back now almost exactly 50%. Just on the nose. That's interesting. Anyway, let's right click here. Let's clear up our drawing set and say, okay, well, we're going to soldier on as the bulls that we are in this webcast that only includes bullish strategies. So I have to throw that out there. We only discuss bullish strategies in this series. It doesn't mean that those strategies are appropriate for every market condition, but let's just say that we are among the traders who think the selling has mostly already happened. Maybe they think that we're moving to the upside. So let's go plan. We're going to plan and place a covered call. But as we do that, I did want to have a talk about this other chart known as the VIX, the Cboe Market Volatility Index. If you're not familiar with this, it's essentially a chart of how much volatility is expected in the S&P 500 over the next 30 days, according to the current pricing of options. When options prices go kind of nuts, this volatility chart will spike, and it's sort of a chicken and the egg sort of a thing, because some people will say, well, volatility prices are, or the VIX is high and therefore options prices are high, or is it options prices are high and therefore the VIX is high? But in any case, a take-home lesson is when the VIX is high, yes, options prices through most stocks and most strike prices are higher than they had been before. Now, there's something else that some traders will say about the VIX. There's a little sing-songy tune. I'm not going to attempt to put it to music, but have you ever heard when the VIX is high, it's time to buy? Yeah. What are those traders who subscribe to that thought, what are they talking about? When the VIX is high, it's time to buy. Well, I'll tell you, they're not talking about options. That actually is intended for stock traders, because very high VIX extremes are commonly associated with very low stock market position, and specifically the S&P 500 when we're using the VIX. Let's put that to the test. I want to bring the VIX back up on a 10-year weekly chart, and let's come down here, pull up a drawing set that I put together right before the webcast started. Look at these highs here. You have a peak up here. Maybe we can't quite see that one up there. Let's drag that down a little bit so you can see this one. But if you look at these spikes in volatility and look at where we are right now, boy, that's matching right up with some of the greatest spikes that we've seen in the last 10 years on the volatility chart. Well, I'm going to load up a second chart. Let's put the S&P below the VIX. Let me switch up the style of the chart here with just a clean candle 10-year chart. And I'm going to load up a drawing set that I've created for this. No, I don't want to delete it. Let's load it. I selected delete. Let's just go to the lows here. There we go. So you can see that just has some arrows. As a matter of fact, there's one on there that's not quite showing. So let's compress that. But when there are extreme spikes on the VIX, notice that commonly is associated with lows where the S&P just doesn't tend to go down much further, like here and here, 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 and most recently right there where we got an extreme spike on the VIX. So for some traders, they say, well, when the VIX is high, that's time to buy stocks. Is it a guarantee that stocks are at lows and they're going to rally? No, it's not a guarantee. But it's still, when some traders see conditions like they're seeing right now, they look back and say, boy, at the moments where these sorts of volatility levels have been matched, if we had the courage to go ahead with purchases on stocks, those have turned out to be some of the best times to buy stocks, which interestingly is a big part of selling covered calls. That's why I wanted to talk about how this sort of a chart has potentially important implications for covered call traders. So, number one, a very high VIX might be assigned to a would-be covered call trader. Boy, the stock prices might be as low as they're going to get in the near term. But at the same time, what's going on with options prices? Options prices may be as high as they're going to get in the near term. And if you want to talk with a covered call trader and throw out an ideal scenario, it would be to get stock prices as low as possible and options prices as high as possible, because we're buying the stocks but selling the options. So, yeah, when we see these sorts of spikes, for some traders, if they already are comfortable with covered calls, if that was already intended as playing a role in their portfolio, they may see this as, ooh, these are sort of optimal conditions. Now, anytime I say that, I have to emphasize, does this mean that stocks have hit a bottom? Nope. They could keep going down further, and they could go a lot further. Does this also mean that just because premiums are high, that they couldn't go higher still and make it hard to get out of short options positions? Nope, that could certainly happen as well. But let's go back to our 1-year chart of the VIX. And we're going to switch this up to an individual stock so we can start to build a covered call. But there's sort of the backdrop for what I wanted to talk about with how this one chart can have these important implications for a covered call trader. So let's go look at a possible covered call candidate. And let's say that our trader is looking for a stock where price has come down substantially. One of those stocks might be Tesla. Tesla right now is teasing right at about what, 7-month lows? We haven't traded lower than $210 in the last 7 months. So our trader might see we've pulled down to those levels. We're starting to get a little bit of a white candle as maybe the markets are showing at least a pulse, and they're considering buying the stock. Now, there is an earnings announcement right around the corner. So how about let's do a covered call that'll have the call out of the way before that earnings announcement. Mark is saying it's definitely a good day for buying covered calls. Could be. Yep, Mark, I can't say that it is definitely. Definitely is too strong of a word, right? Could it be? Yeah, certainly could be. Steve says, I thought stocks are too low to sell calls. Actually, the price, Steve, of the stock does not determine whether the calls necessarily are high or low. Actually, the volatility determines general pricing of calls. In any case, or maybe, Steve, what you could be saying is if our trader, okay, Steve, I think I get your point here. If our trader really is convinced, hey, the stock is at lows, and the last thing I want to do is put a limit on how high that stock could go if it decides to go rocketing to the upside, that makes total sense, Steve. Yep. So maybe our trader just doesn't want to put a cap on this. Well, I wonder if we could get into this. I haven't looked at it, so we'll see. Let's buy some shares of Tesla. I wonder if we could sell some calls all the way up. Could we even do 300? Look at the stock's only at 230. I don't know. This might be unrealistic. But what if we were to look? I don't know about this. We'll have to investigate. Can we sell a call up here at for the 18th of April up at $300? That would be almost $70 out of the money. Maybe under normal circumstances, almost certainly not. But let's go to the, is that as far out as we can get this? What was that? That conference call is on April 22nd. Yeah, I think so. If the trader is trying to do this before the earnings announcement, looks like the 17th of April, that's only 10 days. I doubt we're going to be able to get anything out of it. Well, let's see. Let's crank up the number of strikes that are shown here to 70. Let's go all the way up to 300. You know, it's not nothing. It's not nothing. 86, 89 cents. But let's maybe pull that down a little bit. What would be these highs? Maybe 290. Let's see if we can come down here for the next 10 days. And what was the 290 strike? That's $1.39, $1.44. All right. Now this doesn't mean if somebody's trading a rule, let's say that they've got to get at least 1% of their stock price in their premium, it wouldn't meet that. That would have to be about $2.30. But even that, we might be able to sell at 280. Let's look at this. What if we were to sell the 280, which is still going to be right there? That's still, look at the distance we're providing this. So the trade here would be traders buying at 232. They're agreeing that if somebody else wants to, they can buy the shares from them for 280. Okay, that's still $48 above what we paid for those shares. Theoretically, we haven't bought the shares yet, but it is putting a cap on things for 10 days. So how about we do that one? Now, what I want to emphasize here, though, is getting a 1% return for a 10-day contract that doesn't even go through earnings. That's $48 out of the money. That's pretty close. That is 20% out of the money on this stock. We wouldn't normally be able to get that. Why are we getting so much? It's because of the volatility. It's related to that volatility spike that we're seeing on the VIX. Our stock price is low, but our options premium is high. Under normal circumstances, and I don't know exactly what they might be for Tesla, but I could say that the premiums would probably be a lot less than they are right now. Now, if we want to see a general gauge for how high premiums are on Tesla, there's actually an indicator for that as well. Let me come up here to a little flask icon, and let's go to implied volatility study, which is essentially, it's like the VIX, but just for Tesla. Let's add that to our chart. So this is just a chart of the general pricing of options just on Tesla. So if we look at where this is right now, it's a lot higher than maybe where it would be on average over the last year. If I were to draw a line, just guessing, average might be around there, maybe even a little bit lower. Sometimes our volatility levels have been higher and premiums are higher. Sometimes they've been lower. Yeah, looks like our implied volatility might be closer to maybe 0.6. And right now it's close to double that. That can have strong implications for higher premiums on Tesla. But I'm going to do this. Now, some of you said, boy, if we sold through earnings, the premiums could be even higher. Yeah, I'll bet if we were to go beyond this 17th of April, if we were to go out to, let's say, just past earnings, that could be the 25th of April. What if we went to the 16th of May and we looked at that 280 call? Instead of getting $2.40 or whatever it was, $10, way more. It's because we're having to hold that position through earnings, which is introducing a lot more volatility, driving that price up. But I think we'll stick with the one before earnings. Let's just remind ourselves one more time. We're looking at selling the 17th of April, 280 call. Maybe we can get 250 for it. So I'm going to right click there. Let's go to buying a covered stock. When you select covered stock, that just means covered call on Thinkorswim. That creates an order to buy 100 shares and sell one contract at the selected strike. Looks like 230 would be about the net cost of this, 230, 231, something like that. Let's say that we're willing to spend, well, let's crank it up there since price is moving around quite a bit. As a matter of fact, now we're probably chasing it to some extent. Now 230, 130. Now that's above what it's currently trading for. Let's try to get for 231 net. There we go. Let's click confirm and send. Going to look to try to buy the stock and sell the call for a net of $231 per share. That would be a $23,000 trade. There is a commission for selling the call, bringing the cost up a little bit. But let's send that off and see if we can get that filled. I'm not sure. We'll see. We'll go to our working orders, and it looks like we're offering 231, and it's trading for around there. There it is. Filled it at 230.58. All right. So that's interesting that we were able to buy the stock, hopefully at a low. Time will tell if that turns out to be the case, but get such a fat premium. Well, there's a reason that we get strong premiums at times, and that's because of the volatility, the risk in the markets at the moment. Risk can carry its own potential for reward. But guys, we've accomplished what we set out to do today. I wanted to have a discussion after managing our existing positions, after taking a look at the markets. I wanted to see what was going on with that one chart, the chart of the VIX, the volatility index of the S&P 500, and how that can have important implications for covered call traders. Two different important implications regarding price of stock and price of stocks. Let's broaden that, and the price of many options contracts out there. So we'll see if stocks are at bottoms. We'll see if these are the best premiums that we could have gotten. Time will tell both of those. So we'll follow up on these trades in future webcasts. But it's time for me to let you go. Obviously, don't go yet because I haven't told you. Fill out that survey if you would. Barb has been reposting it faithfully. Thanks for doing that, Barb. But yeah, there's a survey link in the chat window. You can click on that link and it'll activate the survey, and then you can give me some honest feedback. Very short survey, 2 multiple choice questions and a comments box and a suggestion box if you'd like to fill those out. I just always promise if you take the time to fill that out, I'll take the time to read it. Now, a couple of other resources for you though. Make sure, if you haven't done this already, make sure that you're subscribed to our Trader Talks channel on YouTube. You can go right down below the video stream right now and click on the subscribe button. That literally only takes a second. Click subscribe and you're subscribed, and that's it. But our YouTube channel is where we house our previous webcasts. So you can track us down on YouTube, look for Trader Talks Schwab Coaching Webcasts, and on that homepage, you can find our playlists of previous webcasts. You can also join the live streams right here. So for example, if you wanted to see this webcast series, you click on playlists. There are a lot of these playlists, a lot of webcast series that we have done and that we are doing. So if I scroll down, mine is in the middle, 4 up from the bottom. There it is, right there. Trading covered calls and short puts. You can see last week's discussion. Can't afford that covered call. Consider these alternates. That was last week. But yeah, you can also join the live streams there. Make sure you're following Barb and me on X. Barb, fabulous on X. But this is where we can sort of give you more current information without having to wait all the way till our next webcast. And it's where we can interact with one another. When you reply to one of my posts on X, I try to reply right back to it. But for example, I made a post just this morning about the pullback from the recent all-time highs. We hit a 10% correction, 20% bear market, and let me just check something here. Hit refresh. Yep, I had a new post scheduled to go out, and it has. What's going on with this? That's interesting. There's a pattern in how the S&P has been behaving over the last 10 years with a link to a webcast where I discuss these sorts of patterns. So or X is a great resource if you're not taking advantage of that as well. But everybody, thanks for all the thumbs up. I can see we had, about 150 people watching this webcast, and I can see 44 of you already clicked the thumbs up, click the like button. That is always appreciated. It sounds like applause when you do that. It's like a pat on the back to your presenter for their efforts. It also gives my webcast a boost in the YouTube algorithm. It helps more people find these webcasts so they can learn about things like the potential implications of the VIX for covered call traders. So everybody, that's going to do it for today. I will see you in a future webcast. I have a new webcast every day of the market week. I have a new series each day of the week, so I'll look for you in those webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.